It's true what people say. Money talks. With Tackle Trading's Forex Report, you'll always be privy to the conversation. Ooh.
Matt Justice here for Tackle Trading to bring a special edition of the Forex Report. And the reason being is right after I recorded the Forex Report yesterday, China shocked the world. Probably one of the most important decisions China has made in the past 10 years since they officially depegged to the dollar in 2005. They've had a soft peg, where the currency was manipulated to a certain extent. But the Chinese made the decision to devalue the Chinese yuan by about 2% last night, and the impact was amazing. What you're looking at here is the overshore currency pair US dollar Chinese yuan. And as you can see, before today, before the market really kind of moved, you really saw, let's kind of decrease the time frame we're looking at here. So as you can see, it kind of just moved in very subtle movements, really between 6.1211 to 6.27, kind of in that range. In fact, if you look at it from a weekly chart perspective, let's go ahead and look at this a little closer. If you look at it from a weekly chart perspective, you're looking back here and past, and it really never traded up above the 6.28 level. It's currently trading at the 6.40 level, and I've already got a lot of emails, a lot of questions regarding, first of all, why would the Chinese do this? Why would they devalue the currency by 2%, number one? And number two, what is the impact out there to the rest of the not only the foreign currency market, but the market as a whole? Well, I think the decision is nobody really understood the decision at the time. I don't think we really understand the decision now. The Chinese had a lot of room to lower interest rates instead of devaluing their currency. However, when you really kind of look at it, you can understand it to a certain extent. And what I mean by that is when we're looking at the Chinese economy, number one, the Chinese economy is struggling mightily. And whereas you have the Japanese printing money, you have the Europeans printing money, you have the Americans who started this ungodly currency war. You've had over 530 different interest rates being lowered over the course of the last 6 years since quantitative easing in the United States was announced. And so you're looking at this marketplace right now, and it's just like, well, what are the Chinese going to do? The Chinese economy is really struggling. Exporting data recently showed that they had a decrease in exporting by about 8.5% over the course year to year in July. And China is the number one exporter in the world. And whereas many of the other currencies in the region, in China's region, have devalued. For example, when you're looking at the Japanese yen here, the Japanese yen has had tremendous devaluation over the course of the last year, 2-3 years. When you look at some of the other exporting partners in the region, the Chinese yuan has really held up against the other currencies out there. In fact, if you look in the entire marketplace, the only other currency that has done as well as yuan has against the dollar is that of Hong Kong. And when you're looking at those two currencies right there, you can understand why the number one export in the world is sick of all these other currencies trying to devalue their currency. And China's done theirs to a certain extent as well, but you can understand why China would say, okay, if we want to control our monopoly on exporting, we need to devalue the yuan against some of the other currencies out there, so that we can really compete with the other exporting countries in the region, such as Japan and others in the region. So one of the reasons why that the Chinese devalued the yuan by 2% is because of exporting, to really control the monopoly on exporting. The other reason is when we're looking at the Chinese yuan, you got to understand that the onshore versus offshore valuation of the Chinese currency is different. They are not the exact same, and so you have these two different currencies, the USD/CNY, the onshore versus USD/CNH versus the offshore, and the offshore is the one that you can trade. When in terms of those, the values are vastly different, and it's not exactly a free floated currency. It still has a soft peg. There's still manipulations going into the yuan, and so when I'm looking at this, they wanted to make that more consistent. They wanted to make the yuan more consistent with overall the objective of the currency. And what I mean by the objective of the currency, if there is one thing that the Chinese value right now from a currency perspective more than anything else, is the yuan being included, the renminbi being included in the valuation of the SDR. In fact, just recently the IMF came out and basically stated, it was the IMF, but it might as well have been the United States, it might as well have been Japan, but they came out and they stated that the Chinese currency has met many of the things that they were asked to do in 2010 when they were declined Chinese currency inclusion into the valuation of the SDR. And for those of you who do not know what the SDR is the IMF's reserve currency is basically what it is. It's made up of the value of 4 different currencies right now. You have the dollar, the US dollar, you have the Japanese yen, the British pound, and the euro. And many people out there, including myself, have widely expected that the Chinese yuan will be included in the valuation of the SDR as early as this year. Well, there's a report that came out about a month ago, actually a couple weeks ago, that basically said that the Chinese might be put on the back burner, maybe even until September, October 2016, and maybe into 2010. And one of the reasons that was stated is because the currency is not freely usable, meaning it's not determined by supply and demand. And if you're looking at the Chinese over the last 5 years, the Chinese have literally made their currency from a currency that was a non-internationalized currency to a currency that is very internationalized today. 30% of all exporting out of China is conducted in renminbi. You have the renminbi as the second most utilized currency in the world, the 5th largest reserve currency in the world, even though it's not technically considered a reserve. And one of the reasons it's not technically considered a reserve is because it's not part of the SDR. And so the Chinese have coveted this SDR inclusion into the valuation of the SDR. And so this signals another reason what the Chinese are willing to do. And I think even as much as the depegging of the dollar 10 years ago, the hard depegging of the dollar 10 years ago, the Chinese have now indicated that they will do whatever it takes. And what I mean by that is whatever it takes to, number one, help their exporting, whatever it takes to make their currency more freely utilized, freely usable to a certain extent in the marketplace. And you're going to start to see the fluctuations of the Chinese currency inflate and deflate on a daily basis due to what the Chinese are now going to do. The Chinese are now going to make the value of their currency reflect the market forces at the end of the trading day every day in China. And so that's not going to be just 100% manipulated. It's only going to be about 25, 30, 40% manipulated. And so when you're looking at this, it's a decision to help exporting. It's a decision to make the currency more freely usable so that they can be included in the SDR. Now, the impact to this is worldwide. There's no doubt about it. It's absolutely worldwide. The impact is going to impact everything from equity prices to currency prices to commodity prices. And we're looking at a couple currencies specifically. These are the currencies that are going to really devalue when it comes to the Chinese decision on the yuan. And number one is any exporting country. When you're looking at exporting countries, those countries like Japan, for example, are going to struggle with a decision of this magnitude. And as you can see, the Japanese yen has devalued against the U.S. dollar. Since the initial announcement, I haven't seen that huge of a movement, but it's up about 70 pips since the initial movement. Other currencies out there that are not so much tied to exporting aren't going to get hit as hard, such as, say, the euro dollar has had really minimal impact between the decision by the Chinese versus the decision of the Greeks, you really had like you had a very, very volatile day. I mean, it's been moving about 120 pips from the low to the high, but outside of that, it's really kind of break even in price right now. But the currencies I'm very concerned about right now, number one, the Australian dollar. Yesterday we went short heavy Australian dollar, and oh my God, what a home run that was. As you can see, just from yesterday's currency report until today, we're already up 130 pips on the Australian dollar. That was against the United States dollar, but we also went short on the Australian dollar against the euro, and as you can see, the euro has just done amazing things against the Australian dollar, literally up about 300 pips already. What a trade on the euro Aussie dollar pair. That's the trade that you just start locking in profit, and you just say, I just made 300 pips on the Forex report. You go out there and you put it on Twitter. You go out there and you make a comment at Tackle Trading. You go call up your buddies and you say, you know what, I just made 300 pips in one day. Oh my God, 300 pips one day in one move. That's the Forex report out there for you. But we also went long on the Australian dollar versus the Japanese yen to offset some of that risk. And what happened here, and it's still, I love the trade. You basically broke even on the US dollar versus the Japanese yen on those two trades versus the Australian dollar. You locked in 300 pips on the euro. That is what we call a fantastic trade on the Australian dollar. Love that trade. Well, the reason, obviously we didn't know this was going to happen coming into the day, but in terms of looking at this, the commodity currencies are going to struggle here, and the reason being is the United States dollar is going to increase in value. There's no doubt about it, relative to the exporting currencies, relative to a lot of the emerging currencies. And when you look at that, because gold and silver and commodities are priced in dollars. Because of that, China is going to buy less of them. It's going to become more expensive for China to buy gold, and so it's really going to, and more than anybody, it's going to impact Australia. Australia handle 30% of their business is done with the Chinese. They're going to have a very, very difficult time with this decision. They cannot be happy about this decision, and so because the price in commodities, China's going to buy less commodities, which means the commodities are going to get hit a little bit hard, which means the Australian dollar is going to get hit hard. The New Zealand dollar is going to get hard. The Canadian dollar is going to get hit hard. But also because of the fact that especially Australia does such a significant portion of their importing and exporting their international trade with China, that's going to be impacted as well. And so when you're looking at the commodity currencies specifically, we'll just look at them against the US dollar here. Here's the Aussie dollar down about 120 pips. Here's the New Zealand dollar, as you can see, did not get hit as hard. They do not do as much business with the Chinese as the Australians do. And then you have the US dollar CAD pair, and obviously that is rebounded, and that's a great trade we made in the Forex report yesterday as well. I mean, if you look at this, I mean, just in the last day, the Forex reported up about 550, 600 pips, and a lot of it is due to the Chinese. So the Forex report and the followers of Tackle Trading obviously appreciate what the Chinese did. I'm not so sure about the equities market out there, though. I do believe there will be capital inflows coming into the United States in dollar-denominated asset classes. However, when you're looking at it, which means I think there's going to be capital outflows from China into the United States. I think there's going to be capital outflows from the Japanese into the United States. But in looking at this, let's look at the markets here for a second. Number one, the dollar index has not responded the way that you would think based on a lot of these currencies out there moving up and down the dollar index, and Thinkorswim's having a hard time, so let's look at it on here. So as you can see, the dollar index rose slightly. On the dollar index, you're up about 0.2% so far, and that's a lot of that is due to kind of the impact on the euro. The euro's up slightly against the dollar. When you're looking at the pound, down a little bit against the dollar. When you're looking at the Swiss franc down big against the dollar, but it just has not had the impact that we thought it would be, up about 16 cents right now. I do anticipate that to continue to move up in regards to this decision long term. However, also if you look at the S&P 500, the E-mini basically gave up any of the gains it had from yesterday's price action, coming down right into the 200-day moving average. As you can see, big update yesterday, big down day today. That's the world of the U.S. equities markets right now. Gold having about a 0.5% increase, up about $5 today. Currently trading around 11.10. Silver basically break even today, and the VIX up about 15% so far on the day. So when I'm looking at this decision, if I'm looking at U.S. equity values specifically, I'm looking at companies, international traded companies will be impacted more than the dollar-denominated companies such as the small and mid-cap indexes. But I see this as a negative for the equities as a whole. And the reason I see this as a negative for equities as a whole, coming back to the S&P 500, is simply because when you're looking at the S&P 500, when you're looking at the marketplace, when you're looking at everything, we live in a global marketplace, and this decision to me really tells us what the Chinese think of their economy right now. I think they're a little nervous about the Chinese economy, a little bit more nervous than what their economic reports even suggest, because this is a major news out there with regards to China, regards to the Chinese stocks traded in the U.S. marketplaces as well. So I'm taking this as a negative for equities. I'm taking this as a negative for emerging currencies. I'm taking this as a negative for the currencies that are exporting currencies, such as the Japanese yen. I'm taking this as a negative for the currencies that do a lot of importing, exporting with China specifically. And I'm taking this as a positive for the United States dollar. I think this could be a catalyst to see the dollar break out of the trading range it's had for the better part of the last 4 or 5 months. So I'm looking at this, and by the way, when you're looking at the Chinese currency, currently priced at 6.40, that is the largest one-day movement that the Chinese currency has had in over 2 decades. A major decision is going to have epic impacts out there in the market. And I would just like to say, China, welcome to the currency war, and China, welcome to the SDR. This is Matt Justice for Tackle Trading. Hope you enjoyed the special edition of the Forex Report for Tuesday, talking about the Chinese decision to devalue the Chinese yuan by over 2% and the impact to the financial markets and the emerging currencies and exporting currencies out there. Once again, if you like the video, go ahead and make a comment in the Clubhouse or after this video, and we'll get to you. I hope you out there making money one trade at a time.
Everybody knows that money talks, but what they don't know is just how sexy it sounds when it does. Tackle Trading's Forex Report will really turn you on.